If you have a mortgage, credit card debt, or even some savings, the next couple years is about to get interesting. Cause, well, the interest rates are falling. That means more money in your pocket, but only if you know what to do with it. So let's break it down. So recently, I received mail from Scotiabank, my mortgage issuer, that my interest rates has dropped by another 0.25%, which is expected. The Bank of Canada recently dropped the interest rates to 2.75% from a high of 5% a couple years ago. So the prime rate right now for the big 5 banks is 4.95%, which is still high, but it's not as high as 2023 when it was about 7%. With that said, with Trump constantly threatening a trade war with Canada, the Canadian government has pledged to decrease the interest rates even more to make borrowing for businesses easier, and of course to make mortgage payments easier for Canadians who own a variable mortgage rate. At the moment, about 25% of Canadians own a variable mortgage rate, up from 20% before COVID. During COVID, people were enticed by the variable mortgage rates. At the time it was about 1 to 1.5%. Unfortunately, the past couple years hasn't been too kind for people with variable mortgage payments. So the idea is lowering interest rates right now will help these people avoid missing mortgage payments. It's actually quite surprising, but year over year, the mortgage delinquency rate in Ontario doubled in 2024, which might not make sense since the interest rates were dropping in 2024. But it wasn't nearly at the level of 2021 when people were signing up for variable mortgage rates at 1.5%. So many homeowners went into debt between 2022 and 2024, and they simply couldn't keep up with the mortgage payments in 2024 even though the interest rates dropped. And plus, many people with fixed mortgages before COVID renewed in 2024 and the rates suddenly doubled or tripled, which they couldn't keep up. In fact, even with the interest rates falling in the past year, the credit card debt in Canada is at an all-time high. Cause many people were too house poor to pay for their credit card balance, so they only paid the minimum balance, which, if you're aware, charges you like 20% interest rates annually. So today, I'm going to discuss what you should do with your money, given that we're expecting the interest rates to drop in the near future due to Trump's tariffs. First things first, with the interest rates dropping, people start to have more financial freedom. If you're a homeowner with a mortgage, you'll feel less burdened by your mortgage, which means you'll have more cash on you. The most important rule for financial success is paying off high interest rate debts, which means if you have some extra cash on you, you want to go through a list of all your debt and see which one has the highest interest rates and pay off those ones first. For many people, this would be credit card debt. In fact, other than your 6 to 9 months worth of emergency fund, any extra cash should be used to pay off those high interest rate debts. So if you have credit card debt, you shouldn't even be investing in the market. The S&P 500 generally returns about 10% a year, and that's not always guaranteed. Credit card debt is usually around 20% interest rate that you have to pay, which means by paying off your credit card debt, you are guaranteeing a return of 20%. Look, no amount of investments, I don't care if you believe in crypto, I don't care if you believe in penny stocks. Hell, I don't care if you believe the Playboy stock is going to the moon. A guaranteed 20% interest rate saved by paying off your credit card debt is a no-brainer. Other high interest rate debt might include car loans. I've heard of people paying upwards of 15, 16, or 17% on their car loan. If you're paying a ridiculous interest rate on your car loan, try to pay that off as soon as possible if you have extra cash. Most car loans allow you to make extra payments up to a certain amount to reduce the loan period. With that said, this is assuming you can make your mortgage payments first. There's a chance that even with a lowered interest rates, you're still struggling to pay your mortgages on time. Unfortunately, that's another set of issues that has to be addressed. So if you find yourself in that scenario, here's what you should do. First, contact the mortgage lender to work out a deal, perhaps payment deferral plans. Banks are actually very willing to work with you if you fall behind on a mortgage payment, because here's the thing. Banks would much rather work with you than foreclose your property. Because foreclosing a property is a huge time waster and most likely they're losing money in the transaction. In addition, if you're struggling to pay off your credit card debt, there are some things you can do. First, consider putting your credit card debt to another credit card with low balance transfer interest rates. Cards like the MBNA True Line MasterCard, which offers an incredible 0% interest rates on balance transfers for 12 months, although you have to pay a 3% fee for the entire balance. But that's still better than paying 20-something% on your credit card debt. But if that doesn't work because your credit score is too low to get one of those credit cards to transfer your balance, I would immediately call the credit card issuer to work out a deal. Honestly, banks are more than happy happy to work with you because they don't want you to go bankrupt, because if you do, they don't get anything. Next, once your debt is under control, it's time to think about investing. And with falling rates, one of the smartest moves is to move your safer investments into bonds. Now, why bonds? First of all, bonds have an inverse relationship with interest rates. As interest rates fall, bond value goes up, which leads to capital gains. Now, as interest rates decrease, your income from savings account or GICs will decrease, which makes bonds a more attractive option. Of course, unlike GICs or savings accounts, bonds aren't exactly risk-free. As we can see, between late 2021 and late 2022, one of the biggest bond ETFs in Canada, ZAG, dropped by more than 30% in value. And as we can see, during that time, the Bank of Canada increased the interest rates to 5%, which caused the value of this ETF to tank. With that said, bond values in Canada has rebounded slightly in the past couple months and should rebound even more once the government lowers the interest rates even more. So buying bonds right now will be an ideal safe investment for any portfolio. However, I mentioned this before in my previous videos. Bonds should never replace your savings account to park your emergency fund or down payment. Even though bonds are safer investments compared to the S&P 500, your emergency fund and your down payment should not be exposed to any risk. But if you have some extra cash parked in a high interest savings account, consider swapping that to bonds. So as the interest rate decreases, the value of the Canadian dollar is unfortunately also expected to tank. Foreign investors are less likely to invest here because lower returns, which means less demand for the Canadian dollar. Now, when the Canadian dollar drops, a good strategy is to invest in rare metals like gold. Just like bonds, rare metals in general have an inverse relationship with interest rates. As the Canadian dollar decreases, it just takes more Canadian dollar to buy gold, or if you want to sell gold, you get more Canadian dollars. The only problem is storage. Now, in my previous videos, I stated that I used to invest in gold, like those physical gold bars. But I just found it really weird to store these gold bars. Like, should I put them under my bed? Should I put it in a safety deposit box in a bank? So yeah, gold storage was a big issue for me, which led to me selling my gold investments. But if you can find a way to reliably store rare metals, investing in them might be a good strategy as the interest rates continue to drop. So back in 2021, Canada saw a big boom in the housing market due to low interest rates, foreign investors, and a massive influx of immigrants. Wait, the f*** is this? Is that $4 million for this pile of shit? So it makes sense to ask, now that the interest rates are dropping in 2025, should you get into real estate? Now, between early 2024 and early 2025, the housing prices in Canada on average dropped by 3.3%. Because interest rates were high, foreign investors were banned from buying property here, which led to less demand. Now, I talked to some realtors, and many believe that the housing prices will stagnate for the next couple months. Now, I believe that in the next year or two, the housing prices in Canada is going to go up again. I mean, in the short term, interest rates are still kind of high. People's jobs are in jeopardy, which means less purchasing power. And plus, foreign investors are banned and immigration is more limited, which means lower demand. But with tariffs coming, developers has already confirmed that the price of building materials is going to increase. Which means with the housing prices stagnant, it doesn't make financial sense for them to continue building housing projects. However, with the interest rates going down in the next couple years, we're going to have a situation where the demand far outweighs the supply. And with tariffs, everything is going to be more expensive, including building homes, which is going to be passed on to us, the people buying the homes. So should you buy a home in 2025 with lowered interest rates? Well, it depends. If you still have 1 year's worth of living expenses after paying your down payment and your mortgage payments, then yeah, it might be a good time to buy your next home. Now, you might ask, wait, why 1 year? Should an emergency fund be 69 months? Here's the thing, with the economy being so uncertain right now, who knows what's going to happen, especially if you have a variable mortgage rate. Your payments might suddenly increase overnight, so that 1 year is a good safety net for people, especially buying the biggest purchase of their life, their home. So lowered interest rates does provide opportunities for Canadians financially. And the most important thing to do with that extra cash is to pay off your debt with the highest interest rates. And if you do have extra cash after that, consider investing a portion of your portfolio into bonds or rare metals, because the value of those tends to increase as the interest rates drop. And finally, if you have the financial means to purchase your first home, upgrade, or even invest in a property, 2025 might be a good year to do so before the real estate market goes all crazy again. Anyways, that's it for today. If you enjoyed this video or learned something, a like and sub will always be appreciated. And if you're new to the channel, I make financial tips for Canadians in my long-form content and financial comedy in my shorts. With that said, thank you for watching and I'll see you next time.